Warren Buffett is essentially the undisputed greatest investor of all time. He made his first stock purchase in 1941 at the age of 11 and started his professional investment career at the young age of 25. He founded a business that he operated between 1957 to 1969, where his average return during these years was 29.5%. As you can imagine, many people who want to succeed as investors today do not take his insights about investing for granted. You would think he has some well-hidden secrets that could be attributed to his long track record. But this is not true, as Warren never hoards knowledge, judging by how much he shares in his numerous books and interviews. If you stick around to the end of this video, you will see how easily you can also achieve a 30% return per year. Before we get into the 5 most important factors in achieving a 30% each year, if you like our cutting-edge investment content curated by professionals with decades of entrepreneurial and investing experience, consider subscribing to our channel and join in on our alerts so you never miss our new content. To get close to 30% returns per year, 5 important rules need to be employed. They are: 1. The company and industry should be within your circle of competence. 2. Know the intrinsic value. 3. Having repeat and recurring customers. 4. Management of the company. And 5. Understanding the financial standing of the company. Now I'll explain each of these clearly. Be sure to watch to the end. You'll be surprised to know how easy and important number 3 is. Number 1. Company and industry within your circle of competence. It's not enough to know how well the company is doing right now, but how solid will the company be in the next 5 to 10 years? And will it be growing? Also, can you explain how the company makes its money to the average person? If you can't, then it's probably not for you. Can you determine the company's moat? What is a moat? This is the benefit that a company has over its competition in terms of keeping its customers and profitability from year to year. For a company to be successful and worthy of an investment, it must have some or all of these types of moats. They are economies of scale, network effects, switching costs, brand, and intellectual property. Number 2. Know the intrinsic value. This one important rule never leave out, as the omission of it will make other investing rules nearly worthless. It shouldn't be perceived that any investment is worth an infinite price. Whenever you're making an investment, you must be sure it's below its intrinsic value and understand how wide the margin of safety is. The margin of safety is the difference between the innate value of the stock value and what its trading price is. For example, if intrinsic value of a company is 100% and the current trading price of its stock is 80%, the margin of safety is 20%. Ultimately, the larger the margin of safety, the better. Number 3. Having repeat and recurring customers. Good businesses and great businesses have repeat and recurring customers. This doesn't mean that the business model has to have a monthly recurring revenue exactly, but it does mean that the business has to have customers coming back for the product. The best case scenario in achieving 30% or higher will be if the customer base is growing, because if the customers are growing, then the business is growing. Number 4. Management of the company matters. The success of maintaining and managing the growth of a company mostly requires superior management. It's not wise to invest in a business with poor management. A car without a skilled driver can crash quickly. The same thing goes for a company. Hypothetically, if a company has $1 million of outstanding shares and you own $100,000, this means you own 10% of the company. You must know how your shares will be affected if the company repurchases shares at a certain percentage. Number 5. Understanding the financial status of the company. If there's something that is most pertinent to the success of a country, it is its financial standing. Also, in knowing the financial status of a company, you must consider the profit margin. Is the profit margin of the company you're interested in better than its peers? The profit margin of companies varies, and that is why you ought to have dedicated ample time to understanding the company. For instance, a tech company would most likely have a different margin from auto or real estate, and they're not exactly comparable. In the previous year, General Motors recorded a profit margin of 6.6%. You can't comment on its performance until you've compared it with other companies in that line of business, such as Mercedes-Benz, which recorded 13.6%, Ford with 4.0%, and Tesla with a jaw-dropping 16.8%. Also, what is the status of a company's leverage or debt? Are they debt-free or are their debt payments a large percentage of their gross profits? This is relevant because the profit of a company can be affected by their debt levels. To know this, you have to calculate the net debt and EBIT of a company. For example, if a company in 2023 has debt of $30,000 and cash of $12,000, their net debt is $18,000. Net debt in this example is arrived at by subtracting the cash from the debt. In some cases, companies have net cash, in which case they have more cash than debt. So the debt would be subtracted from cash to then yield a net cash figure. Thank you for watching. Tell us what you think about these 5 rules above for achieving a 30% per year return by leaving a comment in the comment section below. If you like our cutting-edge investing content curated by professionals with decades of investing and entrepreneurial experience, remember to like this video, subscribe to our channel,